Welcome to the Lend Academy podcast, episode number 64. This is your host, Peter Renton, founder of Lend Academy. Today on the show, it is great to welcome back Matt Burton. He is the CEO of Orchard and someone who is really at the center of this industry. And I wanted to get him on the show right away. He was gracious enough to do this at very short notice because I'm recording this just a day and a half after the news broke of Renaud Laplanche's, the CEO of Lending Club, his departure from Lending Club, improprieties there that have been reported on extensively. So I wanted to get Matt on just to sort of give everybody some perspective of what he is seeing. He looks at both sides of the business, the investor side and the platform side. So wanted to get him. So we delve into what he has been hearing in the last 36 hours, and we also talk about other things that happened, the other news of the last week. We talk about the Treasury white paper that just came out today, and we talk about Orchard, of course, and what's on tap for those guys. So I hope you enjoy the show. Welcome back to the podcast, Matt.
Thanks for having me, Peter.
Okay, so we're recording this less than 36 hours after the bombshell that was dropped from Lending Club first thing Monday morning. So we've had a little bit of time, not a lot, but we've had a little bit of time to really digest this news. So I wanted to start off really dealing with this head on. So just give us your take on the news out of Lending Club.
Yeah, I woke up to a series of text messages and voicemails yesterday morning with people kind of anticipating big news. And I think when we finally heard that it was Renaud resigning, I was in shock, like many of the other people in the industry. And, I think I spent kind of most of yesterday and today trying to catch up with, industry participants and as well as the press, just to kind of figure out what happened and, where do we go from here? Seems to be a pretty common thread that is kind of percolating through the ecosystem.
Mm-hmm. Yeah, and you've got a fairly unique position here in the industry, talking with both investors and platforms. So what are those conversations been like? Let's just start with the investors first. How has there been kind of any overreaction, or what are the conversations been like with investors?
I've actually been really impressed with the majority of the investors who we work closely with for not kind of overreacting, based on headlines. Most kind of want to see more information and, want to talk directly with Lending Club to get more of the facts. But nobody, paused buying on our platform. Nobody is kind of, taking drastic action as a result of this, which, I think is a really good sign for the industry. And, I expect that, the capital acquisition process, will probably take a little bit longer than it used to as investors are careful, but I don't think that there's going to be a massive pullback. The guys who are on the verge of signing loan purchase agreements, we heard yesterday afternoon a couple of them say that they're still planning on going forward with the existing agreement. And so, I think it might have slowed momentum a little bit, but probably didn't change long-term trajectory for investors.
That is great to hear, because I know you talked about on Bloomberg earlier today, and you were relatively upbeat, and I presume the reason you're relatively upbeat is what you said is that so the investors that you speak with are not changing anything as of right now. That is quite amazing to me, and it shows obviously a lot of confidence in the industry broadly. Is there, so as far as conversations go with platforms, is there, how has that been over the last 36 hours?
Yeah, I think, the first reaction I think most people had was just shock. And then kind of the realization of like, wow, this has been a really rough 7 days of news in the industry between, Prosper, kind of right-sizing their business for the current conditions and, the on-deck earnings and shifting more of their loan volumes, the balance sheet, which Wall Street, as that they didn't have demand for their loans in the marketplace is a negative sign, which, I think is not completely true. But, and then, even Square, got kind of hammered when they came out.
Mm-hmm.
And so it's just been tough, but, overall, I think that it's been an overreaction. You look at a lot of, the more that you dig into these results, the more that you talk with the platforms, they feel really good about their long-term prospects and the businesses they're building. And I don't think the business models are at question here.
Right.
I think that there was, a speed bump we hit in terms of the capital acquisition in February and March. This was not limited to just our space, but, across the credit spectrum. And, this is the first time that our space has really hit something like that. And so, of course, it was challenging, but, the long-term prospects of the industry are going to depend on how we react to these types of situations and how we make sure that we build in, the proper, procedures in place to make sure it doesn't happen to us again and that we're not surprised by it.
Right. I saw a comment, I think it was from David Klein at Common Bond, saying, Renault has left the industry, but the fundamentals have not left with him. The fundamentals of the industry are still the same. And, it feels like that's the press obviously they love a juicy story like this. And, there's been hundreds and hundreds of articles written in the last 36 hours. And, it's good to see that, that there's certainly some people at least talking common sense. And it sounds like that's what some of the people you're talking with. So where do you, when we're looking back here in, 6 or 12 months time, do you think we're going to see this as like a speed bump and the start of a pretty rough stretch, or not even the start? Because we've had some challenges in the last couple of months, as you just mentioned, but, or do you think there's going to be a fundamental shift in the industry, or how do you feel like it's going to impact us going forward?
Yeah, I think one is we're very focused on what's going on in the U.S. on this conversation, and it's obviously a super important market. But in my conversation with platforms internationally, I don't think that they're going through this market turbulence like we are. So that's always kind of good to remember as we're going to look back upon this event, because most of the concern is related specifically to the consumer unsecured space. In terms of kind of where we are in kind of what I would call the press cycle, as well as I do, when this space started growing and starting to get covered, there was no one talking about it in 2011
right.
or even 2012. And the press was just completely ignoring the space. And then there was this discovery phase where they wrote a lot of articles about discovering it. And then, I think that the space got, a lot of hype. And now, after the hype phase, the press is always looking for the teardown phase. And so I think that's what we're going through right now. And, I think what comes next and whatever it is, 6 or 9 or 12 months will be the rediscovery phase, and so we'll just have to kind of work our way through this press cycle and continue to let the numbers speak for themselves, build profitable businesses that grow and, impact both consumers, small businesses, and investors in the right way. And I think we'll be fine. It doesn't feel good when you're kind of in the eye of the storm.
Right. So in some ways, what you're saying is this may really be the beginning of the next phase. Like the hype is all gone. At Lend It last month, the hype was pretty much gone anyway. There was, we've all know about the challenges that some platforms have had and with investors pulling back. But it sounds like this may really be the next phase of the industry. And, I tend to agree with you there. I think we're going to have, so the fundamentals are unchanged. The challenge may be is that for companies like Lending Club, it's going to take a while for them to regain trust, with investors. So do you think you're going to see capital maybe moving away from Lending Club and into Prosper or Avant or Marlet, or what are your thoughts on where investor capital might go just in the short term, like the next 3 to 6 months?
Yeah, I mean, it's hard to tell today where that's going to be. I mean, I do believe that capital will flow to the platforms that have created the highest amount of trust, the best in class systems. Data transparency is huge for investors right now. Mm-hmm. And, in my belief, and it came up in the Treasury white paper, is we need, secondary markets in this space. And so I think the capital will also flow to platforms that embrace secondary markets once those get live. Mm-hmm. But yeah, I mean, I think that it's going to be an interesting next 6 months on the capital acquisition side. And, from my standpoint, almost every single platform is hyper-focused on capital acquisition. So we'll see which ones, do the best job.
Right. I want to talk about secondary markets in a little bit, but I want to just expand on that next point. Like you say, which ones will do the best job? So, clearly, if you're trying to raise equity capital right now, and I know you guys did a raise, late last year, but this must be a terribly difficult time to be raising equity capital. I mean, do you think we will see many companies go under in the next 6 months?
I personally don't think we're going to see a lot of companies go under. I think if you're looking on the originator side, companies that are, let's say you're originating $50 million a month and you're break even or losing a little money. My guess is that almost all of these platforms could cut their volumes by a third or half, take out the less profitable portion of their origination, and become cash flow positive. Probably have to go through some resizing of the company size, structure in the process. But I think that a lot of them have the path to getting cash flow positive if they wanted to make that happen. Mm-hmm. Now, what does that? It comes at the cost of growth, though, and equity investors have been prized. Growth over everything has been kind of the mantra,
right,
for the past 18 months when it comes to these equity investors. And so I think that those days are done. The difficulty in raising new equity today is unless you have a forcing function, unless you have a reason for investors to act now, they're going to kick the can down the road and try not to make a decision. And that, what used to take 3 months to raise a new equity round could easily be 6 or 9 or 12. Mm-hmm. And that's just, it's a very difficult thing for entrepreneurs to be in that situation because you want certainty around your funding. Because it's very hard to plan when you're not sure when your next equity round is going to be. Right.
Very good point. Well, anyway, I do want to move on from the Lending Club saga and talk about a few other things because it has been a busy news week for the past week. We started off, we had the on-deck earnings first, which disappointed many people. And their stock was down dramatically, not quite as dramatic as what Lending Club went through, but certainly it declined a lot. And I wanted to get your perspective on Deck's first quarter earnings. Do you think they were punished a bit too harshly? What's your take?
Yeah, I mean, I think what you're seeing is that the equity markets react to the fact that because capital is more scarce in this space, they're expecting growth rates to slow. And if you look towards a lot of the forward guidance that was given, it kind of lines up with that. So that's kind of one piece to it. The other piece was, I think they were punished, or at least in the news, for having a shift from funding their loans via their marketplace to funding them off their balance sheet. And this speaks to a core problem that I feel like a lot of these companies have today, in that it's not clear what metrics equity investors should use in order to value these companies. Mm-hmm. And so there's less and less equity analysts out there. And if your business is fundamentally hard to value, and it's a newer business model, in OnDeck's case, it's a hybrid model, it's just kind of an uphill battle. And so you see these times where it's kind of like, anything doesn't go perfect, and there's just kind of like, a lot of panic that goes on. So I think as an industry, we really need to figure out, how are these platforms going to be measured? Because, multiples off revenue, clearly doesn't make sense. I think on the other extreme, book revenue doesn't make sense. And we've got to figure out a way that an equity analyst can do kind of an apples to apples comparison of a couple different platforms and be able to understand which one's doing a good job.
Right, because that
relative to each other.
Yeah, that's a good point, because we're not listening to their on deck earnings call, and it feels like with the marketplace, if you're selling loans on the marketplace, you recognize the revenue right away, and if you're selling on the balance sheet, you recognize the expenses right away, as far as you've got to kind of expense all the provisions for losses up front. So it's a huge difference in earnings when you're recognizing what might be a 1 or 2 year loan, you're recognizing all the revenue up front, or you're recognizing all the expenses up front. And it feels like this is going to be the challenge. They want the flexibility of moving from a marketplace onto a balance sheet and back again, but it's just going to make their earnings are going to be affected so much. So, as you say, it looks like that people haven't worked out how to do this. I mean, what are your thoughts? How do you think they should be valued?
Yeah, I think it's a tough question because these are brand new businesses that have I think today the hybrid model has a lot of attraction, and you see a lot of newer originators go that direction, because it allows you to fund your business in a lot of different economic environments. But the downside of that is, to what our exact discussion is, it's harder for you to explain the intrinsic value of your company to an investor. Now, in my view, is that the easiest way, to explain your value is just become profitable. If they just start making money, everything gets easier. Right. Then we can argue over the details, but I really think that's, if these companies just could get as profitable as quickly as possible, a lot of the short sellers would be pushed out of the space.
Right. That makes sense. So let's move on to Prosper. It feels like 3 months ago that they announced their round of layoffs. Given it was only 7 days ago. So as we're recording this anyway. So what are your thoughts on the news out of Prosper? And obviously it's given the Lending Club news, it seems like not that big a deal at all. Obviously it's a big deal for those people who lost their jobs, but wanted just to get your reaction on Prosper.
Yeah, I think that last year, take Lendit, for example, there was a ton of announcements by a lot of platforms. Oh, I'm going to do this product line and then that product line and then serve, all of these different populations. And I think that you realize that that's a really hard thing to do. And when times are good, though, you have, equity investors who are supportive of all of that, and you have big growth targets, so you want to kind of stretch your core competency. And I think, what Prosper realized was that they had kind of stretched themselves too thin a little bit. And in the current environment, it didn't make sense for them to be trying to do multiple products at once. So, they decided to cut back and go to their core, which, I think was the right decision. And, you can, hindsight is 2020. You could argue, you shouldn't have expanded last year, or you expanded too fast. But, it's really tough when you're in the moment and you're dealing with a lot of different constituencies that you're trying to please, both internal and your board, and, potentially going to IPO, that, mistakes can be made. But I think that they did a good job of hopefully dealing with it all in one shot. And it's not going to, the worst I've seen for startups is where they have like a trickle off layoff, where like over the course of a year, there's like 9 different layoffs. And that's just the painful way. Hopefully, they just took their medicine all at once and can now grow from here.
Right. Sure. Let's hope that is the case. So now switching gears to the Treasury, they just a few hours ago released their report. They did their request for information last summer, and we now have the fruits of that labor, I guess we would say. So did anything stick out for you in the report today from the Treasury?
I was actually really pleased when I saw it the first time. I think that a lot of the recommendations, were mentioned by, companies in the RFI, obviously the devil's in the details on a lot of these things, but just kind of reading through, the common themes and then, their recommendations, I thought they made sense, right? I don't think that, any of the industry participants would, disagree in a large way with a lot of them. But I mean, the common themes were, making sure that, transparency was at the core, that you have sound operations and credit models, that, borrower enhancements and safeguards needed to be improved over time, setting a high bar, and obviously, the secondary market piece is something that's dear to me. So I was glad that got mentioned. And then, I think it was important that they said that, regulatory clarity can benefit the market. The people actually in this space want to know, how to build businesses in a way that the regulators will view as being best in class.
Mm-hmm. Yeah, for sure. I think, and one of the other things they talk about is, the regulatory clarity will benefit the market. And I think that's something that we're not going to be clear on for some time. But I think this is certainly, I think all of the regulators can look at this and, it sounds like, and I haven't read the whole thing yet, given that it's like, 40, 50 pages long and, it came out a few hours ago. But it's clear that there doesn't look like to me to be any really bad news for the industry in this at all, as far as I can see. And that's what was a worry. And I think it seems like a good resource for regulators as they're considering any changes that may come. Speaking of which, do you there seems to be a lot of activity these last few months on the regulatory front. Anything you're hearing out of Washington, D.C. that you can share?
Yeah, I mean, I think, at Orchard, we filed for our broker-dealer. So we've had our own list of stuff that we've been busy with FINRA and the SEC. So that's kind of been a focus of ours. But overall, I mean, the Treasury used some of our data for their white paper, and we've seen kind of an interest in a lot of the different governmental organizations just to get education on our industry. I would say education and data are the two things that they're looking for the most. Mm-hmm. So we have seen kind of an uptick on that side. But overall, it's been pretty quiet. I mean, this is an interesting time for DC. It's a presidential year. They got a lot going on. We haven't been in the spotlight yet, right. And hopefully we won't be. But I'm glad this white paper came out. I agree it can be a good guide for other regulators to understand the space. And hopefully, we find a way to continue to work together as an industry to build relationships that go deep with regulators. Yep,
for sure. So I want to talk about Orchard, at least for some of the show here. I know there's been a lot going on, but firstly, why don't you just give us an update? I mean, obviously, I think when we chatted back in February, you just seen in the previous couple of weeks things had really shifted on the investor side of the business. So why don't you just give us an update on what's going on at Orchard, how you've been affected over the last 2-3 months?
Yeah, I mean, I think the disruptions within the credit market in February led to a lot of the people who were kind of working their way down our funnel on the institutional investor side to take a look at the high yield market or other spaces. And so I don't think those investors are necessarily gone, but they're relative value investors. So they had other places to kind of look for a little while. So we did see kind of a slowdown in activity moving through our funnel on the institutional investor side in Q1. Interestingly enough, there's a lot of new investors who have come into the space who are more kind of distressed investors. They kind of move in when the headlines turn negative. So over the past 3 weeks, it's been interesting to watch them come in. But most of actually the activity at Orchard over Q1 has been on the originator side, as we have signed up, a number of partners and have gone through kind of our onboarding process where we, help standardize, normalize, and bring up the quality of the data to an institutional grade to get these platforms ready to start working with multiple institutional investors. And so we've been super busy. I mean, we had 16 integrations going on in Q1.
Wow.
And,
does that mean 16 different platforms, or is that?
Yeah, 16 different data sets that we were normalizing.
Okay.
Yeah, platforms, exactly.
Right.
So, yeah, I mean, it's across merchant cash advance, small business term, and consumer unsecured have been. And then, obviously the next steps for us is student and auto are the ones that we're getting asked and kind of that we're seeing. But overall, everybody's taking capital acquisition more serious. And so, we've seen, a lot of interest in our product line on the originator side to help them institutionalize themselves to a greater degree.
Right. So then let's just talk a little bit. You mentioned you're applying for your broker dealer license. You talked about secondary markets. I mean, I think we chatted, I think it was back in 2014, and you'd hoped to have secondary market in place within 12 months. Obviously that didn't happen. Where are you at today? Is this something that you want to do yourself, or what? Or firstly, why are you getting a broker dealer license, and it doesn't have anything to do with the secondary market?
Yeah, so the joke in my product and engineering teams is we've already built secondary markets twice. This is going to be the third time that we build it.
Third time's a charm.
Yeah. So yeah, what's interesting, I mean, it's just to go back to the Treasury white paper. I mean, the regulatory uncertainty has been at the heart of this problem, in which, multiple times we've gotten close to coming out and launching them, but haven't been able to get the reassurances from participants and from regulators that we know that we're in good standing. And given our expectation that this is going to be an important cornerstone of the industry, we want to do it the right way. And I don't want what happened to Lending Club and Prosper to happen to me, where we spend a ton of time and energy, building it only to find out later that we get shut down. And so, we ended up going through the whole process again through last fall. And, finally just said, look, I don't think we're ever going to get the exact certainty that we need. We better just get our broker dealer and, take the stance that we expect that the SEC is going to regulate this space, that it is a security if there are, pools of loans, and then just build a business with that standard in mind. And so that's how we've decided to move forward.
Right. So you have willing participants on both sides, on the investor side and on the platform side, as far as participants in a secondary market?
Yeah. So on the platform side, we had willing participants last year as well.
Right.
What's been interesting in Q1 is we've seen a number of institutional investors come to us and say, hey, I'm looking to sell a portion of my portfolio, or I want to double down and focus all my buying on one of the consumer platforms versus buying on three. So there's definitely the demand right now on the investor side as well that we're seeing. But it's one of those things that until we get our broker dealer, we're not going to feel comfortable having those transactions flow through us.
Right, sure. So do you think there's also demand from institutional investors for aged portfolios that they to buy outside of the securitization markets? Do you see that as a possibility as well?
Yeah, I mean, I personally think there's demand there. I haven't, it hasn't been told directly to me recently. We're going on a road show next month to just go talk to a wide variety of both platforms and institutional investors, both in this space, but also participants that we think would be good to bring into the fold. And so I think I'll probably know the answer to that question better by the second week of June.
Right. Okay. So before I let you go, just what else is happening at Orchard? I hear you're about to move into new offices. I mean, what else are you working on?
Yeah, so for anyone who's been to our offices, it is super cramped at the moment. And I feel really bad about it. But at the same time, signing leases in New York City is not an easy process. So it looks like we're going to be moving into new offices in July. just getting the final details done on the lease. And it will be, exciting next step for the company is, we've been in 5 offices in the past 2.5 years. It looks like we'll be able to stay at this one, hopefully for over 2 years, but we'll see. It's the nature of the beast when you're building startups. It's tough to have the right amount of real estate because you tend to outgrow it quickly.
Yep. Right. Okay. Well, it's always a pleasure chatting with you, Matt. I really appreciate your time today.
Yeah. Thanks, Peter.
Okay. See you later.
Bye.
I hope that has provided everybody with a bit of perspective on the current events. It's easy to get wrapped up in doom and gloom and the sky's falling when you're following the articles in the press. But Matt has certainly shed some light on the fact that it's business as usual for a lot of people in this industry. Now, having said that, this doesn't mean that there won't be an impact, even a potential dramatic impact on some participants. And we obviously don't know what the fallout's going to be at Lending Club. But the reality is this industry is strong. The fundamentals are unchanged. And I expect, as does Matt, that we'll be around for a long, long time. On that note, I'll sign off. I very much appreciate you listening, and I will catch you next time. Bye.